You're live.
Did you know that a car used to cost $3,500 in 1971, and that same car today is over $50,000? And the question is why?
Yeah, this is a question that I think some of you are aware of, but one of the reasons why inflation is so important is because it's really changed, obviously, since the 70s when Nixon took the dollar off the gold standard, which is called the Nixon shock. So you're going to hear us today talk about compared to what. So compared to what means, when you decouple the dollar from gold, literally decouple it, because it used to actually be tied to gold. So when you decouple it, what does that do? It gives the government the ability to print. And so why is that important? It's important because you now have more dollars in circulation. We created this whole credit bubble, which you guys have all experienced. And I know I'm going back a little bit here, but this is obviously 50 years in the making. But if you take a look at, let's say, the cost of a house back in the 70s, you're talking they're in the $20,000 range. Now they're in the $400,000 range. So the question you should be asking is not necessarily, are you a great real estate investor? The question is, why? Why did a house go from 20 grand to over 400,000? That's the question. And the answer is because of what's been happening with the dollar. So the dollar actually has gone down in purchasing value during that period of time because there's been so much money printed. And so this is really why there's the haves and the have-nots. This is why people have gotten really rich by staying in assets, and others that have just been focused on wages, fixed income. They're getting annihilated, and this is not going to stop anytime soon, right?
No, and let's go back to the beginning. So when Nixon took the dollar off the gold standard, before, in order to create dollars, you had to have gold to back it. So when that was taken off, you could print essentially as many dollars as you wanted to print. And that's when inflation really took off and really started. And that does expand the economy, though, right? Because when you're printing more money, there's more money to move in circulation for people to buy things. There's more jobs. So there is a benefit to it. And when he did it, it was beneficial for the economy. But with that creates inflation, which is why a house was 20 some thousand and now is over 400,000. But when you were saying compared to what it really means is compared to what wages, right? Like,
Correct.
so, people made more money now than they made back in the 70s. So 25 grand now is a lot less than it was in the 70s.
But those also exploded too. So that's the other thing. Like the median household income in the 70s was around 10 grand, right?
Hmm.
Because I remember you guys have heard the story with my mom. My dad passed away, and I had the unfortunate experience of diving into their finances, right? So if you guys have gone through that, you know that that's horrible. But nonetheless, my brother, my sister, and I, we had to dig in. And my dad had an insurance policy. It was 10 grand. And he had a house that they bought in the 60s for about $11,000. Well, fast forward, that policy was still worth 10 grand. And the house now is worth over 700,000 because it's in the Seattle area. So it appreciated a lot. And my mom was a hairdresser and my dad was in construction. So it wasn't because they were phenomenal real estate investors. It's just because they had paid off that house. So they had done this, they had bought the house before the dollar decoupled from the gold standard. And of course, they knew nothing about this. But the issue that we're going to keep circling back to here is that assets drive wealth. The assets drive wealth. And so that's why we keep preaching on this channel about, get yourself into hard assets, whether that's gold, which is today at about $3,400 an ounce. Back then in the 70s, it was $35 an ounce. So why is it that these hard assets have gone up? And if you look at the real wealth in this country, it's because of what Danille touched on a minute ago, which was the credit piece. So in the 70s, the United States had $500 billion in debt, right? In credit, right? 500 billion. Today, it's 34 trillion. So that's the difference. So we've got this massive credit bubble, this massive expansion of the credit, which gave rise to the banking, wealth management, finance, derivatives, all of those things that you guys are now seem pretty obvious to you. As a kid, we didn't have all that stuff, right? And what it did is just blew up this Wall Street, the financial services sector. And as a result, we also moved the financial education from the home, to the school. That's exactly what happened.
Yeah, so going back to compare to what is okay, so say that a salary was 10,000 in 1971 and a house was 25,000. That's 2.5 times the price, right? So 2.5 years worth of a salary bought you a home. Today's average salary is right around 80,000 and a home is over 400. So now you're at over 5 times the amount of a salary to buy a home. And not even just that, but cars have went up 1,300% as well. And basic groceries, even in the last 5 years, have went up. So the money you're making is not going as far. So even though people were only making 10 grand in 1971, their money was going farther. And to your point, people back then didn't live on credit. Nobody, I don't even know if people had credit cards then. So,
They were starting. That's a really good point. Credit cards start. This is kind of the rise of the credit card
okay.
during that period of time. And you guys know, like this dollar is now debt, right? The US dollar is technically debt now that it switched over. And as a kid, I remember if I ever had a $20 bill in my hand, do you remember it was like I was rich. And we never ever saw a $100 bill. And now, of course, these are in everybody's wallets. Everybody walks around with hundreds. So what happened from the time, really what happened? Why was it 20 such a big deal when I was young, and now to my kids, let's say their generation, it's hundreds. It has very little to do with what we're doing as investors, and this is kind of the point of today's video. The dollar turned into debt. And then all of a sudden, these things became worth less. Not worthless, but worth less. So back in the 80s and 90s, this used to buy a lot more. Now it buys a lot less. Same thing here. So if you had $100 in your bank account back in the 70s, it bought a lot more. Today, of course, as you guys know, I went to dinner last night with a buddy, and it was $100, just the
Mm-hmm.
two of us, and it was not a fancy dinner, by the way, and no bottles of wine or anything like that. It was literally just dinner. Now he ordered a few things, but regardless, as you guys know, I'm not preaching to the choir here. I mean, things are more expensive. Like if you go, just for basic stuff now, it's really, really, really difficult. And what Danille was trying to point out earlier is that wage growth is not followed. So just what we saw in the last 50 years, we are going to see again, right? Because the dollar is still decoupled, and now we have these international issues with the other countries being a little bit upset with us because we trade in U.S. dollars. The world trades in U.S. dollars. So if we pay for something, let's say from now we have all these tariffs and that's a whole different issue. But when we buy stuff from foreign countries, we pay in U.S. dollars. And they hold U.S. dollars. And so that's why it's important for you guys to be watching the DXY, which is the dollar index. And the DXY right now is something that the other countries are watching. Because if I give you a dollar and you're in Canada and you're holding a US dollar and I'm devaluing it, you're not happy with me, right? So that's what's happening. So as we're paying the world in US dollars and we keep printing like crazy to fund things, then we start to see the dollar lose its purchasing power and its value. And that's precisely why people are running to gold, people are running to crypto, people are also outside of the US are considering another type of a currency.
Yeah, and it happened from the 70s till 2025, and it's going to continue to happen moving forward, which is why it's important that you guys get out of cash and into assets. And, if you look at Trump's presidency in general, it's inflationary. Trump wants inflation. He's going to have inflation through tariffs, whether you like it or
The
not. It's
big beautiful
happening.
bill,
The big beautiful bill. He wants the Fed to lower rates.
right?
When he gets his new Fed chair in May, they for sure will lower rates further. All that is inflationary.
So if you know this too, but if you guys know these things and we know this is happening, that's your playbook going forward.
Yeah, exactly. But if you know that this is going to happen, you have to be investing in assets. Your dollar's just going to lose value. If you're waiting to buy a home prices are just going to go up because it's already more expensive to build some of these houses than it is to buy them. That's what Ken's doing with multifamily. He's buying assets that would be more expensive to build because if people are going to build new ones and they're more expensive, they're going to have to sell them for more than what you're buying them for. So you have to take all of this into account when you're looking at what to do with your money moving forward.
Yeah, and I know we're gonna take a break for our sponsor here, but I'm gonna talk about debt and how you guys can get on the right side of this right after we listen to this word from our sponsor.
Gold is near all-time highs, but appreciation isn't the only way to benefit. Monetary Metals, you could potentially earn a yield on your gold, paid in physical gold, without selling it. Here's how it works. When you lease your gold through their platform, pre-qualified companies pay to use it under strict guidelines, like renting out real estate but with gold. Instead of paying to store your metal, you may earn up to 4% annually in gold. You stay in control and you can choose which leases to participate in. Monetary Metals handles the due diligence, lease terms, and all the administration. Thousands of investors use this approach to grow their gold, not just sit on it. Visit monetary-metals.com/Ken to learn more. Leasing gold involves risk and returns are not guaranteed. This is not an offer to buy or sell securities. Please review all risk disclosures at monetary-metals.com. Visit monetary-metals.com/Ken to learn more.
So there's two things that I want to talk to you guys about now as a result of where things are headed. If you have to understand that this next administration under Trump is going to be inflationary. Obviously, we haven't seen the tariff inflations yet, right? But everybody believes that we are going to see them at some point. They have to show up as things are going to be more expensive somehow. If we're going to do iPhones in the U.S., they're going to be more. So so there's going to be all kinds of things that are going to show up. The big beautiful bill for sure is going to be inflationary. There's a zillion studies on this, and so these are going to happen. And we all know what Trump feels about interest rates. So interest rates create bubbles. So if you know those three things, the key to this next little run here for all of us is going to be to get into what we would call good debt. So what does good debt mean? Good debt means that you're using debt or you're using other people's money or OPM. You're using a loan or something from somebody with a fixed rate interest, and you're using it to buy something. So a lot of you maybe that don't have money, you literally could borrow 100% of somebody else's money, lock yourself into an asset that rises with inflation using other people's money, using zero of your own money. Now, you're still in debt, and the cost of that debt is important. Don't get me wrong. But debt is going to be really important. And here's why. As we buy all our apartment buildings, let's say we buy 75% debt, 25% equity. Equity is the down payment. What that really means is I'm borrowing 75% from somewhere else. It could be a life insurance company. It could be from a retirement plan. It could be from a bank. It could be from the government. It could be from HUD. The point is, I'm borrowing that money from somebody else. I'm hedging that into an asset that's going to grow in value as a result of this inflationary cycle that we're about ready to come into. But I'm hedged. If I buy a $100 million asset using $75 million of debt and $25 million of equity, then I still have that $100 million asset. And the question should be, how much is that $100 million asset going to be worth in 10 years? Because that's my hold time. I plan on holding that for 10 years. So if inflation is, let's say, 5% a year, that's 50%. That means just by doing nothing, that asset should be worth about $150 million just because of what inflation does. Now, I know that's not perfect science. Maybe it'll be 2, maybe it'll be 3, maybe it'll be 7 or 8 or 9% like it was just a few years ago. But you get the point. The point is, I'm not talking about operations. I'm not talking about how I'm running it. I'm not talking about passive income. I'm not talking about any of that. I'm just talking about getting in the game and actually using debt to buy a hard asset. And fixed rate debt is the most important thing because that's what got everyone in trouble right now. The people that are losing assets right now have floating rate debt. So fixed rate debt is really important.
Yeah, and you have to remember that inflation is good for the government. The government likes inflation. They like inflation because it reduces the real debt that they have. They like inflation because it encourages spending and investment. Because if you hold your money and it's worth less in 5 years, people want to go buy a house. They want to invest in the stock market. They want to invest in crypto. So it's good for the government. It supports wage growth because inflation, you guys get a 3% wage growth every year because there's 2% inflation, right? So like if there was not inflation, you would not get wage growth. And then lastly, it prevents deflation. And the government does not like deflation because deflation actually makes their debt heavier. Like if our dollar, if it takes less dollars to buy something, then we still have to pay it back in that same amount of dollars. So that's bad for the government. That makes tax revenue go down, which is also bad for the government. And people stop spending because if you know that prices are going down, just like we saw in 08 on housing, everybody waits. They wait because prices are going down. So the government does not like deflation. It's not good for the government. Inflation is what is good for the government. And you always have to follow what's good for the government because they're always going to do what's best for them.
Right. As I like to say, be the Fed. So deflation, let's give you an example of deflation because a lot of us could get caught into this deflation period. All right. When you buy a car, a new car, I can tell you right now that new car is probably not going to be worth more than what you paid for it. That's an example of deflation. When you buy a phone, right, an iPhone, that's going to be worth less. A computer is going to be worth less. A flat screen TV is going to be worth less. Those are going to be deflationary. Not to say you shouldn't buy those things, just understand the difference. Now, let's take a look at, the real estate as an example, or gold, or anything that actually is going to track with inflation. That's the key. And be careful of these very convenient, well-marketed stocks and bonds and mutual funds that are called, inflation hedged or these inflation type of vehicles. Be very, very careful. What you really, really want is are real things. That's why I love Chris Martins's book, Peak Prosperity, what it talks about at the very bottom. It's called Tier 1 assets. Lumber or timber, water, gold, silver, real estate, things that are actual physical, because everything comes from the ground, and then it, of course, gets produced by a company, and then, of course, it turns into a stock at the top, and that's paper. That's the most risky spot. It's called a derivative. So gold starts at the ground, then there's a gold company, and then there's a gold stock or an ETF. That's not gold. That's paper. And as you guys just Google this, there's more ETFs than there actually is physical gold. So that's called a derivative. So you want to be in physical gold, and because that's always going to be the most valuable. You can throw it in your pocket. You could take off to Europe or Mexico. You can pull it out and you could go get pesos or whatever it is in whatever country. And so it's universal. That's what we're talking about here. We're talking about physical assets. And those for sure are going to inflate over time, just like they did from the last 10 years, 20 years before that, 30 years before that, just as we've proven to you guys. And this is common knowledge, right?
Yeah, I think it's good to understand that inflation isn't just a number, it's how the US finances growth. Like The US has always grown through inflation. So just think of that when you continue to invest, get in those hard assets. Don't wait, right? Don't wait to invest in those things because they're not going down anytime soon.
Yeah, and just before we wrap up, the question is, what do you guys think is going to happen to this in 10 years or 20 years, right? Like seriously, what's this going to be worth 10 years from now? Is it going to be worth more to you or less to you? And so if it's worth less, then why would you save these? Now, I'm not saying you shouldn't have cash reserves. I'm not saying that. What I'm saying though, if your strategy is to save and have money into a bank during an inflationary time period, you will be on the wrong side of this, right? And I talked about my mom earlier. I was up seeing her last week. She's on a fixed income. When my dad passed away, she's got this fixed income, and that fixed income buys less and less and less every single year. And so what she used to be able to pay for 10 years ago, she can buy less of today. Now, obviously, thankfully, our families, got her back and taken care of her, but that's actually where everything's headed. And that's why everybody's so tuned into this. If you're on Social Security or you're about going to get Social Security at some point, that's why everybody's so tuned into this inflation adjusted language. How much is the government actually going to increase your Social Security each and every year? And you guys know it just hasn't kept up, right?
Yeah, absolutely. All right, well, you guys have a good one, and we'll see you next
All right, guys. Cheers.